Every 15 to 20 years, the financial world goes through a violent transformation. We call this the Great Market Shift. It usually means end of an era. But the terrifying part is the shift always happens exactly when we feel the most secure. That sense of safety you feel today isn't comfort. It's a trap. Because the last time the world felt this safe, it was a most dangerous moment in financial history. Back in 2006, an economist named Noral Roubini stood in front of the IMF and warned that the US housing market was a house of cards and it would crash the global economy. The audience laughed. They literally laughed at him. They called him Dr. Doom. Why? Because the stock market was at all-time high. The data looked perfect. 2 years later, nobody was laughing. 2008 crash was the most devastating market collapse after Great Depression. Roubini was not a psychic. He just looked at one signal that everyone else was ignoring: the bond market. And right now, we're watching the exact same laughter happening again. The S&P 500 is celebrating, but the bond market, the smart money, is screaming that the music is about to stop. This is the great market shift. And we are going to find out why these two markets are telling us completely different stories and which one is about to be right. Before we dive in, I would appreciate if you could subscribe so that I can bring more of such videos to you. I spend time analyzing data to bring quality content to you so you can make informed decisions for your investments. Let's dig in. Imagine a luxury skyscraper. On the top floor, there is a massive party. The music is loud, the champagne is flowing, and everyone is celebrating the view. But in the basement, the engineers are watching the concrete foundation split in half. That is the state of global economy right now. Penthouse is the stock market. It sees liquidity, it sees the record profit, it sees a soft landing where the party has never to stop. The basement is the bond market. And engineers down there are seeing something terrifying. And that terrifying thing is called Un-Inversion. And this is the contradiction. Usually, the penthouse and the basement are the part of the same building. The fact that they are living in two different realities is the anomaly. And to see if the building is safe, we need to inspect the foundation. In finance, the way we check the fundamentals of bond market is through yield curve. I'll keep the math simple. Normally, if you lock your money away for 10 years, you get paid more interest than if you lock your money for 2 years. But before every recession in history, this flips. The short-term rates go higher. That's called inversion. Now here's the secret that Wall Street doesn't tell you. The crash doesn't happen when the curve inverts. That's the warning. The crash happens when it uninverts. It happens when the curve snaps back to normal. Back in 2007, the curve uninverted right as the stock market hit the peak. Why? Because bond traders realized the economy was rotting from inside. They realized the Fed was behind the curve and they would have to slash the rates desperately to save the system. The uninversion isn't a fix. It's the bond market saying the Federal Reserve is too late and bond investors need to get their money out of the system before a crash happens. And this exact action crashes the 2 years bond yield that causes the yield curve to look normal. But in real sense, it's nowhere close to normal. And this is exactly the thing that is happening right now. After the longest inversion in history, roughly 2022 to 2025, the yield curve is going back to the normal again. So if the bond market is seeing the crack in the foundation, why is the stock market is still partying? This brings us to the human element and why our brain is wired to ignore the warning. Think of stock market like a drunk uncle at a wedding. He loves the open bar. In finance, the open bar is liquidity. When the Fed says we might cut rates, the stock market hears free drinks. It doesn't care why the drinks are free, it just wants to party. But the bond market is the designated driver. These are the people managing pension funds, sovereign debt. They don't care about party. They care about getting home alive. And when they hear the rate cuts, they don't think about free drinks. They think, why do we need cuts? Is the engine failing? Is the driver having a heart attack? And right now, the drunk uncle, the stock, is buying share because he thinks the party will go on forever. The designated driver, the bond market, is panicking because it sees a cliff ahead. And historically, the driver is usually the one who knows where the road ends. So where does this leave us? I'm not suggesting to liquidate your 401k and buy gold bars. That's reacting to fear, not data. But I'm suggesting to keep an eye on the 2 years bond yield. Many times people get blindsided by headlines on S&P 500 and ignores the 2 years bond yield. Think of this as the market's truth serum. If the yield stays stable, the soft landing may be a possibility. And if this number starts to dive, especially if it breaks below 3% rapidly, that is the bond market signaling that the Fed is behind the curve. That has historically been the signal that the shift is underway. If we see that happen, it might be a time to prioritize safety over growth. Markets are cyclical. They run on emotion just as much they run on math. In 2007, the prevailing emotion was invincibility, and that blind optimism is exactly what kept investors from seeing the crack in the foundation. And today, we have the benefit of hindsight. We don't have to predict the future to be prepared for it. Thanks for watching. I'm Sean. And if you really enjoyed this video, then please click the like button. And if you're interested what is coming up next, then please subscribe. Thanks for watching.